Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just about 30 minutes to go now until the closing bell, and stocks mixed here as investors digest economic data and a barrage of news out of Washington. Sliding tech stocks weighing on the NASDAQ. Meanwhile, the Dow edging higher on the heels of a rocky session on Wednesday. Well, Treasury Secretary Scott Bessent addressing interest rates and economic growth in his remarks at the Economic Club of Minnesota. And Yahoo Finance's Jennifer Schonberger joining us now with the latest. Jen.
Hey there, Josh. That's right. Treasury Secretary Scott Bessent says the Federal Reserve needs to do its part to boost investment in the economy and says that interest rates need to be substantially lower.
The White House can only do so much. At a certain point, the Federal Reserve must also do its part to spur investment. I think that we are still substantially above the neutral rate, and I think that we should not be in restrictionary mode.
Bessent says that the Fed needs to have, quote, merely an open mind, pointing to former Fed Chairman Alan Greenspan, who he says resisted raising interest rates during the go-go 90s technology boom, allowing the economy to expand. Bessent says he thinks that interest rates should be somewhere in the range of 2.5 to 3.25 percentage point, though he doesn't have an exact target for interest rates. Of course, right now, rates are in the range of 3.5 to 3.75%. Now, Bessent did offer an update on the race for the next Federal Reserve chairman, saying that there is still one more interview left to go of the 4 candidates that are under consideration, and that is the head of global fixed income for BlackRock, Rick Rieder. He said that the president is expected to make an announcement for his choice for the next Fed chair, either before or after he goes to the World Economic Forum in Davos, Switzerland. That is slated for January 21st. Now, Bessent also offered some clarity on the president's announcement to ban institutional investors from purchasing single-family homes, saying that that is not going to be retroactive. They are not going to force sales. Instead, it will apply to future purchases. And we also got an update on the tax season. Bessent said that tax season is going to start on January 26th, the earliest it has in, he says, a decade, to allow Americans to benefit from those large tax returns as early as possible. He says this is going to act as a major tailwind for the economy this year. Josh?
All right, Jen, thank you. Appreciate it. The Supreme Court is currently weighing the legality of many of Trump's tariffs, but in the meantime, we're dissecting what hangs in the balance this year due to tariffs. Yahoo Finance's Washington correspondent Ben Worskell here with the very latest. Ben.
Yeah, Josh. So the very latest is that all eyes will be on the Supreme Court tomorrow at about 10 a.m. We know that the court is gathering, and we know that they've said they may issue opinions. There's a lot of speculation here in Washington that this tariff decision will be the decision that is offered. This is, of course, about Trump's blanket tariffs. We had arguments last November about the legality of those. These are tariffs that make up about half of his entire tariff regime by revenue. It's about 55%. And a lot of kind of questions about sort of what this will mean in a lot of different scenarios of what's going forward. As for what happened, as for what the decision will be, it's really anyone's guess at this point. The sense here is that there's 3 justices that we know are kind of in one camp or the other. There's 3 in the middle, John Roberts, Amy Coney Barrett, and Neil Gorsuch, who tend to side with Republicans, but also ask pretty critical questions at the arguments last November. So those are going to be the ones to watch tomorrow, depending on which sides they fall on. Again, could be tomorrow at 10 a.m. It could also be in the weeks ahead, but this is coming at some point in the next few months.
And Ben, what is being said, though, on the likelihood of how SCOTUS rules on tariffs? What do we think? What's the smart bet?
Yeah, I mean, the bottom line here, the overall sort of context here is that over about half of Trump's tariffs aren't going anywhere, no matter what the decision is tomorrow. It's about 45% of the tariffs by revenue are sector-specific tariffs that are laws that aren't under review. The other point I think is underappreciated is how many different flavors of an opinion that could be. This isn't necessarily a straight up or a straight down decision. The justices were pretty skeptical, so they seem to have a lot of questions about the legality here, but there's a lot of ways they can kind of give Trump a bit of a loss, but not strike them down entirely. Maybe some national emergencies are legitimate for these tariffs. Maybe some aren't. The other huge question here is refunds. It's a way that would be a real messy process if they force the Trump administration to return these. But there's a way that they sort of strike them down, but don't force the refunds, which would be a whole nother level of complexity. Either way, any negative decision for Trump would cause a lot of short-term turmoil in the trade landscape, even as Trump and his team have promised they're going to get Trump's tariffs back to where they were, no matter what the decision is tomorrow or the months ahead.
Ben, thank you, sir. Appreciate it. What's been whiplash for investors this week is President Trump royals sectors from housing to defense to energy with policy ideas and military action. But my next guest says investors don't need to react to the geopolitical risk in a material way. Join me now. We got Rebecca Patterson, former Bridgewater Associates Chief Investment Strategist. Rebecca, it is great to see you. So President Trump, a lot of headlines there, Rebecca, a lot of social media posts. Affordability, of course, is front and center for the administration now. Maybe start, Rebecca, and there's a range of ways we could go here, but housing, let's start there, because Trump says, you know what we should do? We should ban big institutional investors from buying single-family homes. What do you think, Rebecca? Smart policy?
That's a meh. That's my technical term. There are some analysis out there that suggests that the institutional firms buying up these homes leads to higher rents. At the same time, it can bring down home prices. So the jury's out on whether this is the optimal policy to address the housing affordability crisis. I think there are a lot of other things that can happen. Congress is already looking at a couple different bills. They're going through the process that would do things like speed up permitting for home development or push local and state government officials to have more supply of starter homes. So there's different things that will probably get done that have bipartisan support. So this step by the president makes for a good narrative as he's starting to look at midterms. But I think there are other means to, really handle this that don't require an executive order from the president. In addition to that, though, you need lower mortgage rates. And right now, we're seeing 10-year yields kind of ticking up a little bit. So focusing on fiscal sustainability, frankly, would probably do a lot more to help the housing market than this particular policy idea from the president.
Another area I want your take on, Rebecca, events in Venezuela and what you make of what we're seeing and hearing there. The Trump administration seems to be saying, you know what we're going to get is big oil. Big oil, we can get them back in here into Venezuela, Exxon, Conoco, and they can help really reshape, remake that industry and market. Obviously, it would take a lot of money and a lot of time, but what do you make of that, Rebecca?
Yeah, let's tie that to the affordability crisis. Look, if you can get more global oil supply and supply growth outstrips demand growth, you will have lower prices. And that certainly helps the consumer today. If they have to spend less filling their vehicle, they have more money left over for other things. So lower oil prices, great news for the consumer. It would help bring broader inflation down at the margin, which maybe can help the Federal Reserve cut rates a little more in the future. So all that's good news. The challenge with the oil plan is really time frame and companies' willingness and ability to go to Venezuela and do things quickly. I mean, if you are a large oil company, you care about certainty and the oil price. The lower the oil price, the less cushion you have for a new project to be profitable. And right now, oil prices are relatively low. The other thing is certainty. You want to know who the government's going to be in Venezuela, not just for the next 6 months, but for the next 6 to 10 years. You want to know what U.S. policy is going to be. You want to know that your employees there are going to be safe. So there's a lot that has to get done before I believe you see major oil companies going back there in size. So the possibility of more oil supply coming out of Venezuela is there, but I think it's longer term. It's not going to do anything to address the affordability crisis between now and the midterm election, quite frankly.
All right, so a lot of questions remain. Here's another question. That big jobs report, Rebecca, on deck. We got other economic data today, though. I'm curious what you make of that data. What do you make of just the labor market, where we are, Rebecca, where we're headed, and what that means for the American consumer?
Yeah, so the good news with the labor market is that there is a lot of data to parse, and really you're going to do better predicting what it means for the Fed and the consumer by looking at it holistically. And today we had Challenger and Gray, so that's layoff announcements. We had weekly jobless claims. When I look at all this together and including tomorrow's payroll report, the picture I'm seeing is one where you're not seeing a speeding up of layoffs. That's good news, right? Companies aren't rushing to fire everyone. At the same time, they're not hiring very quickly or picking up hiring either. The Challenger and Gray report today showed a little bit of a pickup in hiring. That's great news. But if you put it together with the whole last quarter, it's still a pretty cautious picture for employers. The bottom line for me here is that the Federal Reserve's last cuts were done in part as insurance to make sure the labor market doesn't deteriorate faster. We're not seeing any data since that December meeting that suggests they need to cut again in January for this reason. I think we're going to have a pause from the Fed in January, and they're going to want to stay data dependent. Scott Bessent today, Treasury Secretary, said they need to keep an open mind. I believe they are. They're looking at all the data, and they're going to let the data help them decide if more rate cuts are needed, how quickly, and how many.
Finally, Rebecca, I do want your take on the stock market. Wall Street seems to be all in, Rebecca. I don't remember the last time I had a strategist on the show who wasn't constructive, who wasn't bullish, but I'm curious to get your thoughts as we start a new year here.
I echo what you're saying. It feels like everyone is on one side of the ship. And look, there is a narrative that's quite reasonable to support that. As we heard today, the tax refunds are going to come soon. They're going to be large. That should support consumer spending for at least a few months. It's possible that job cuts don't get worse, so people have incomes that helps them spend. The Fed may ease again a little bit later this year. That's supportive. So there's a lot to like about the equity market. At the same time, when everyone is on one side of the boat, it pays to think what could go wrong. And we just talked a minute ago about tariffs. Tariffs are going to stay, but there's going to be volatility around that. These policy surprises create a level of uncertainty. I think you've seen that reflected in the markets this week. So I personally say, yes, you can stay invested, but make sure you have diversification within your portfolio. Things like global defense stocks, which are not going to trade one for one with AI stocks. Having a little bit of gold in a portfolio through an ETF, a gold miner, what have you, having some short-term fixed income, getting some global diversification as well. So I think you can stay invested. There isn't a reason to think we're going to suddenly have a recession, of course, but you want to make sure you have enough diversification in those assets that you can kind of ride through these policy shocks and continue ideally to compound over time.
Now, last question, Rebecca, I got to ask, since you mentioned those defense names, what did you think of Trump's comments on that sector? Because he doesn't sound too thrilled with some of our defense contractors. Did that make you reconsider maybe your bullishness there?
No. So he's saying two kind of contradictory things right now in defense. On one hand, he doesn't want them to do as many buybacks. He wants to cap executive pay. And you could say, yeah, that could be negative for the stocks, the sector. At the same time, he said he wanted to increase the defense budget by $500 billion, which would obviously be very beneficial for these companies. With executive pay, the government does have leeway to put in stipulations in future government contracts that have to do with executive compensation. So they can affect things going forward in some areas. But the president does not have the ability to just blanket tell companies and sectors what to do. I think more than anything else, he's just trying to show them what he would like to see happen and hope that they fall in line, at least directionally.
All right, Rebecca, always great to see you and to have you on the show. Thank you so much.
Thank you.
Coming up, we look at a few key internet stocks our next guest says are poised to benefit from increased consumer demand. That's next on Market Domination. Evercore ISI out with its 2026 outlook for internet stocks, saying this year is a story about compounding. Joining me now is the author of that very note. That would be Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore ISI. Mark, it is great to see you. So you say you are compound constructive on internet stocks this year. You say high quality names they can sustain premium earnings growth of 20% while multiples hold. Maybe start there, Mark. What makes this a classic compounding environment in your opinion?
Well, the bad news is going forwards is that we're 3.5 years into a bull market, especially for tech stocks, and especially for what has now become an AI portfolio. So that means there's very few what I call dislocated high quality or DHQ opportunities in the market. And I'm not sure that multiples are at peak, but I wouldn't be buying most of these stocks in the belief that multiples can go higher from here. So there's a little risk going into next year. You can throw in whatever macro screens, and you should, on top of that, and that may make one cautious. I do think that these you can find a good number, call it 5 to 10 high quality names in large cap internet. Good assets like Google and Meta, like a Booking.com. Names like that, an Uber that can that justify their current multiples, their growth does. These are high quality names with a lot of good growth and profit outlooks, and you can buy those and hold on to them, and I think they'll give you decent returns. There's a few that I'd really want to lean into specifically here that's not on that list I just mentioned, but that's what I mean by they're high quality companies that can hold their current multiples, and they go higher because their earnings, they outperform the market because their earnings outperform the market. In a world where S&P 500 earnings grow 15%, I'm highlighting a group of stocks that can grow their earnings 20% year over year. Multiples hold, those stocks will outperform.
I want to get to those specific names, Mark. Before that, though, this was an interesting point as well. You talk about consumer demand, Mark, and you're talking about how it has remained resilient across a number of verticals: rideshare, travel, e-commerce. What data, I guess, Mark, gives you the confidence that, it's going to stay resilient, given how much we talk about on this show about the cooling labor market and these broader questions of affordability and economic anxiety, Mark?
Well, all of those could change, no question about it. It's just all I can do is I've got some pretty good reads into the current consumer mindset. And, I do cover $1 trillion in retail spend. That's Amazon, Shopify, eBay. And I cover about $500 billion in ad spend. That's Google, Meta, and a bunch of other smaller names. And a lot of travel names. That's the most discretionary segment you can find out there. So I cover a Booking, an Airbnb, and Expedia. You add that up, that's about $300 billion in spend. And this is not high-end, high-end exclusive resort travel. This is, average leisure consumer travel in the most discretionary sector you can find out there. There was softness in the middle of last year, but it came back. Consumers are back, traveling, and the bookings window that we have, and this all can change. You can get external shocks that can change this. We had external shocks in April of last year that impacted demand. But right now, so we have to keep watching out for these. But right now, the demand seems very resilient. I think that's the right adjective to describe how the consumer is holding up, not just in the U.S., but globally.
Mark, another theme I want to touch on with you. You think AI CapEx ramps from $350 billion in 2025 to $450 billion in 2026 among the mega caps. What does ROI, Mark, look like on all that spend? What are the signs and the signals we're getting as investors?
Yeah, I think these companies, that's Microsoft, Amazon, Google, Meta, are all leaning into AI. They believe that this is a real dramatic product inflection point. So these are rational capitalists. I assume they wouldn't be leaning in more if they didn't think they were getting a good return. I have to step back as an objective analyst and see, do I have data points that prove this? Well, I do have some wonderful data points out of Meta. You've seen an acceleration in their ad revenue growth for 2 or 3 years now. You've seen a dramatic inflection up in the revenue per employee across all 4 of those companies that I mentioned. There's a lot of things that go into that number, but I'm absolutely certain that AI productivity boosts, not just costs, not just better management of costs, but productivity boosts are part of that. And then I just worked on a report on this wonderful application called Rufus within Amazon that's already generated something like 10 billion in incremental sales for Amazon. That's a small number for them, but the product just rolled out. The feature is really just very recently rolled out, and it's led to the 60% increase in conversion for Amazon shoppers who come in and use Rufus. I think you're going to start seeing more and more deployments and applications. Then you're going to see online retail, online travel, online advertising, all of those are going to have performance improvements, and they already are starting to show that in terms of AI, and it's going to show up in the P&Ls. You're going to see these sustainably high revenue growth rates, and in some cases acceleration. In fact, my number one pick is Amazon, in part because I think you're going to see this acceleration due to AI. And I think we're going to look back on this a year from now or 2 years from now and said, yeah, those were the signposts when you saw those revenue growth rates start to accelerate.
You mentioned Amazon, Mark. I think that's your number one pick. I also want your take on Alphabet. Officially overtakes Apple as the second most valuable company in the world. The stock, Mark, it's up around 90% over the past 6 months. What do you make of that name? Is it still a buy here, Mark?
Yeah, it's still a buy. I had this as my number one pick, 9 months ago. This to me is classic DHQ. And this is what I've been doing for the last almost 30 years. I look for these high quality assets. Hopefully I've gotten better over that time. I look for these high quality assets and wait for them to be dislocated. And I thought Google at 15 times earnings was classic DHQ candidate. Turned out to be right. Okay, I got that one right. I've got plenty of other stock calls wrong. But I like the setup on Google. And I think this is one of those stocks now, you're not going to get that kind of return going forwards. You've had the big re-rating. The multiple went from 15 up to 28. It's not doing that again. You're not going from 28 up to 40, or the chances of that are very, very tiny. I think what's more likely to be is a compounder. They'll be able to grow earnings, in excess of the market, 20%, 25%. And the stock goes up by that. So there's no doubling in the stock over the next 12 months. It's extremely unlikely. But, the stock has gone up for very legitimate reasons. They have proven that they can be successful all up and down the AI tech stack, from deployments. The advantage that Google has is that it's got just about the cheapest infrastructure going after AI. And then they've got, multiple ways to monetize AI through cloud, and also through using AI to better monetize these billion user platforms that they have, whether that's search or YouTube or Google Maps, Gmail. And so it's just great to be you're a vertically integrated company that wins on cost, wins on scale, and is now winning on product rollouts thanks to AI. I'd stick with Google. It's just not a back up the truck price. It's, if you don't have some, do you build a full position right from here? No. But do you have some long exposure to Google and hope for a little bit of a pullback so you can buy more?
Mark, always great to have you on the show. Thank you, my friend.
Thanks, Josh.
Now time for some of today's trending tickers. We're going to start here with Caesars Entertainment. That stock getting an upgrade over at Susquehanna. The firm lifting its rating on Caesars from neutral to positive. Susquehanna noting an attractive risk-reward setup for that stock. The firm adding that it expects consumer tailwinds during the time period of March and April, given tax refunds and deflationary forces. Susquehanna also lifting its price target on that stock from 25 to 31. Turning to Jefferies, the investment bank reporting fourth quarter earnings that missed estimates. Jefferies noting a pre-tax loss of $30 million associated with its investment in Point Bonita, a fund in which they hold an equity interest in that had faced major issues tied to the bankruptcy of First Brands Group. However, putting the noisy quarter aside, UBS sees Jefferies well positioned to benefit from anticipated 2026 capital markets acceleration. Last but not least, automakers are getting a bullish call from Piper Sandler, the firm lifting its rating on Stellantis and General Motors from neutral to overweight. Piper Sandler saying Stellantis with the most upside potential, while noting GM has too much earnings power to ignore. Ford also getting an upgrade from Piper Sandler as well, raising its rating on that stock to overweight, firm highlighting Ford's refocusing on its most lucrative segments. We're wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.